Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've actually been reading his articles for years. He was the lead researcher at Casey Research. He wrote some very interesting articles. He's done a ton of site visits in, I think, over 60 different countries. It says on his Independent Speculator website. He's been doing this for almost 20 years now, visiting a lot of different countries, projects, looking for good mining stock opportunities. Lobo Tiggre, thank you for joining me.
Well, thank you so much for having me on the show, Jason. It's funny to hear you make that intro, and it sounds like, God, 20 years. That's not that much. There's my mentors, the Rick Rules and the Doug Caseys of the world have, a couple more decades on me, and I still feel like a bit of a puppy. But it is a long time to spend traveling the world and kicking rocks. I have seen a lot of rocks, and which ones ended up being mine and which ones didn't. So it is I don't know. It just struck me when you said it. That's kind of my thing, I guess, kicking rocks.
And the other important thing is you've been through a lot of bull markets and bear market cycles. We're in a bear market cycle right now. How do these bear market cycles normally play out with mining companies, capital available, and projects?
Well, there's a leading question. So I'm not pausing because I don't know what to say. I'm pausing because there's so much that I could say. Narrow on the.
Well, the more information you provide, the better, because your experience.
Okay, so I guess a couple of key points to start is that I don't want to just be a cheerleader and say, there, dear, don't you worry, you're pretty head, everything's going to be fine, and lead the lambs to the slaughter, right? I mean, things could get really bad. If we're looking at something that's like 2012, when the whole sector went into reverse, it wasn't, gold and silver kind of led the way down, but it was everything, right? Everything went into deconstruction mode, and people got hurt. And people who listened to the gurus who said, don't worry, everything will be fine. The fundamentals are on your side. Ignore the technicals, right? A lot of people got hurt. So I'm very reluctant to take on that role. That said, my macro view, my fundamental view, and I think you can even make a technical case that we are in clearly a bear setting now in the resource sector. But I don't think it sticks. And the major caveat there would be, let's see the shape of the global recession that's taking form in front of us. That will obviously have a lot to do with how metals and mining in general shape up. And we really don't know yet. I mean, the knee-jerk is that recession is bad for industrial commodities. Of course it is. There's no doubt. But we also have, the guys in Washington and Brussels and other places with their hands on the money valves, right? So it's hard to say exactly how this will play out. If we have something that doesn't repeat but rhymes with the 70s, you could have higher prices for commodities in the face of recession. So it's a mistake to just assume, things have to go down the circular drain. And it's also a mistake to say, the good guys will win, so I'm just going to close my ears to anything I don't want to hear and bet long. So we got to stay on top of this and pay careful attention, I think.
Confirmation bias is very dangerous. I just hear the phrase repeated all the time, dozens of times per day, mainstream financial media, everyone who was short commodities the last couple months, the commodities futures contracts, a lot of them, especially base metals, are down. I think the copper miners ETF is down over 40%, might be over 50% now in the last 6 months. I just hear the phrase demand destruction repeated constantly. Is there actual evidence, though, that demand for a lot of these base metals has collapsed?
I think the evidence is actually pretty confused. If we take the example of aluminum, for example, it's not just it is a supply chain disruption, but it's also, it's more than that. So if you have this power problem in Europe and you have aluminum smelters shutting down, so that's gonna create a supply disruption, but it's also, it's not just the consumers or the buyers who aren't going to get their aluminum, are going to have to pay higher prices to get their aluminum. Think about it. If you're the mine that supplies the bauxite to that smelter, this is a big bulk commodity. And if you're not going to ship it all the way around the world to some other smelter, or any other smelter than the one that you're using is likely to going to cost you more. So you've also got an immediate plug in the tailpipe that's going to affect the miners actually producing the raw material there. So it's not just this one little kink in the supply chain that's causing a problem. It's the whole setting and in the backup all the way up the chain. So it's a major disruption. On the other hand, why is that happening? Well, because you've got a war, you've got an economic war, you have, it's not just the energy itself. It's everybody in Europe saying, holy cow, the brown stuff's about to hit the ventilator, and pulling in their horns and pulling back and cutting back production. So I think it's a little bit more complicated than, is there demand destruction or not? And I think, we run risks of looking too deep into the crystal ball. The Palantir, they don't always show you what you want to see, or what you think you're seeing isn't always true. I think it's important to go back to something I said before, and this is that the baseline expectation is that, yes, of course, we're going to see demand destruction if there's a global recession. And I think that's unavoidable at this point, and it's pretty much happening now. If you look at Europe, and we'll see, we get GDP numbers this week in the US. It'll be, I think, a shock to people in the US if that turns out weaker than they expect. But at any rate, there is clearly a slowing, whether you want to define it as a recession or not, or whatever. There's clearly slowing, and that clearly affects demand. It affects the companies and their, whether the consumer has stopped spending yet or not, whether the layoffs have started yet or not. The companies making their plans, you can hear that in the earnings call. They're pulling in their horns. The talk of layouts is starting, and I do think that makes a difference. Your purchasing managers are out there. They're not going to want to go wild and crazy buying up all kinds of raw materials if they don't know if they're going to be able to have consumers willing to buy them, in the months down the road when they're ready to sell their produced goods. So, sorry, long story short, the track record here is really kind of grim. And I think it's important for resource speculators and investors not to be Pollyanna, not to set it aside, not to be overly optimistic. When there is a recession, that's pretty much always bad. And you can talk yourself into why this time is different and so on, but it's pretty much always bad. So my base case expectation is that for your aluminums and nickels and coppers and everything, we are looking at more downside in the months immediately ahead. Maybe the next couple quarters are going to be painful. So if you can't handle that, it's not time to buy the dip yet.
But there is.
Sorry, just real quick. But so I would separate out monetary metals. If the same thing that causes the industrial minerals and metals to go down sparks the right fear, you could have safe haven demand that would cause gold and silver to react differently from other metals. So that's one thing. And then the other thing is, how much pain can the powers that be tolerate? Like I mentioned earlier, I do think that there are people in Washington and Brussels and Bonn and other places that they have their hand on that money spigot. And even if the central banks have to talk tough on inflation, we've already seen that, major Western economies and governments have no problem with contradictory policies of giving out free money and talking about tightening at the same time. So watch for the fiscal response, watch for the fiscal response to potentially change what the recession means for commodities.
Have you been in a cycle where there's enormous amounts of demand destruction and then also supply destruction? And then also supply destruction at the same time simultaneously, and then maybe supply destruction is actually starting to occur faster then?
No. And it sounds like, if you're not in the industry, it sounds like it happens at the same time, but there's usually some delay. And even if you're a miner that is producing at a loss, you will often keep producing at a loss for some quarters before you think about pulling the plug on the mine, because it's not like a factory that you can just shut off, cover the machines to keep the dust off, and then dust them off later and start it on again. Many mines suffer significant harm if they're not actively in production. And you can put them on care and maintenance, but even that's expensive, especially if it's an underground mine that has a lot of water flow. You spend a lot of money pumping water out of those. And if there's not people there keeping up with things, there can be rock falls, there can be A lot of them are in tectonically active areas. That's why there's a deposit there in many cases. So most miners, okay, if they make, I don't know, tens of millions of dollars a quarter and prices go down, so now they're losing $1 million or $2 million a quarter, they might just suck it up and keep going rather than see their mine go out of harm. You also have contractual obligations with your buyers sometimes, or relationships you don't want to break, things like that. So there can be reasons why they'll continue producing even at a loss. You've probably heard Rick Rule say that miners are famous for taking losses and trying to make it up in scale and, increasing their production. And it's kind of funny, kind of sad, but it's true. That actually happens. And there's a crazy argument for it. If you have, X cost per unit and you're losing money, but just a little bit, and if you can increase your output and reduce your cost per unit, you could actually potentially lower your costs so that you're not losing money anymore. But usually it doesn't work that way. The prices go down. You can't keep up. Well, also, again, long story short, what I'm saying is that it takes the industry a while to respond. And commodities are so famously volatile that you don't really know as a miner, okay, I'm taking a loss this month or this quarter, but maybe next quarter will be better. So they often just don't shut down unless they have no choice.
Well, also to add to your points, they're also for miners to increase production and to lower cost per unit. They have to make enormous capital investments. So that's the difference between the mining business, which is more difficult, more volatile with commodity prices going up and down. They have to make enormous increases. It's not like a restaurant business where if the restaurant has bad locations, they can close some of the locations, or other businesses where they can slash costs quickly. They can sell inventory, raise cash. The mining industry is different. Normally, to lower costs, they have to make big capital investments.
Right. Or, some of these things, you can't run the mine at half capacity. It just doesn't work. And the other thing is it can have longer term consequences, because say that you don't have a plan for increasing your production to lower your unit cost. What do? You either shut it down and take all kinds of damage, or you say, where the high grade portion of your deposit is. And you can say, okay, well, we'll just go after the higher grade material right now while prices are low, and we'll stay afloat. And then hopefully it won't last too long, and we'll be back to business as normal. That can be done. If your average grade for copper is 0.5%, but where there's a sweet spot that has 1% copper, you could double your copper output for the same amount of mining if you focus on that one area. It makes a huge difference. The problem is that if the downturn lasts and now you've mined out the best part of your deposit, and it used to average 0.5%, but you mined out all the 1% stuff. Well, now you're left with 0.25% because you mined out the best stuff. We call that high grading. And if you high grade your mine too long, you can actually sterilize what's left. You can ruin it for the future. So this is one of the reasons why it takes so long often for the sector to come out of a downturn, is that mines will operate longer than they should because they don't want to shut down. And then when they do, they often suffer a lot of damage. So it takes a long time to bring them back, if they can even be brought back at all.
That's exactly what happened during the bear market in 2015, 2016. Things were dire for the silver miners. Costs were rising, and the metals price got down, I think, $15 or even below 15 briefly. And I was getting emails, text messages, comments below social media. Is Silver Wheaton going to go bankrupt? This Pan American Silver, at the time, they were the lowest cost silver miner. Now they're not. They had really bad quarters, high cost mines now, problems with the mines. But, it was just total panic, and capital was not available and costs were rising.
Yeah, but that same time frame, if you think about what happened in early 2016, we had that huge bounce that turned out to be sort of a head fake, right? It really piddled away. Late 2015 was the bottom. The 2016 bounce didn't put in a new low afterwards, but it almost got there. And boy, did those silver miners just go nuts. They were five baggers amongst the bigger players. Just because people were so hungry and so ready for some good news there, and it's funny. So, in going back to your initial question and kind of framing it in terms of what do we do now as investors, it's a really tricky spot, because on the one hand, I don't want to just say, oh, just hang in there, everything's going to be fine. You don't want to miss that 2016 bounce, like we just talked about. It could happen tomorrow, right? On the other hand, that actually could happen tomorrow. It is true. You don't know when the fiscal response will turn things around. But my general sense is, I don't know the future. I'm not saying, follow me, be fearless, I'll always be right. But my sense is, for what it's worth, is that we're probably looking at more pain in the resource sector writ large for the rest of this year. And then as the Fed gets to pausing, I think that can reverse the DXY strength we've seen recently. And I think that can help even in the face of recession. And then it's up to what the fiscal response is.
Yeah, I think those are reasonable assumptions there. And you're not going all in. You're looking at metals prices. You're looking at fundamentals of companies. The base metal miners, though, they went cash flow negative about 6 to 8 weeks ago. We've seen comments from the Rio Tinto CEO, and this may be a contrarian indicator that the bottom will be in the next couple quarters, maybe based on what the Fed decides to do with their balance sheet, quantitative tightening, ending the interest rate hikes. But he said the commodities bull market is over. I mean, a lot of it, though, Lewis, is dependent upon government spending. So if China announces that they're going to do more infrastructure spending, or the U.S. announces some type of infrastructure spending pack, maybe an additional infrastructure spending package, let's say they get the changing propaganda index or CPI down a lot. They get that down. Right. That then the both political parties in DC will say, oh, the official inflation number is down and the dollar is strong. Oh, we can spend more. So we're going to spend on infrastructure.
Right. That's certainly there. Let's jump back for a few seconds to what you said about China. I think a big variable here too is, and I'm not a China whisperer. There are a lot of people that know more about China than I do. I have been there half a dozen times looking at rocks. But that doesn't make me an expert on the Chinese economy, and I don't pretend to be. But for whatever it's worth, just my sense of the human critter and what's going on over there is that the zero COVID policy is a real problem for them. But saving Xi's face and not backing down is obviously paramount as well. So I don't think they're ever going to declare an end to the zero COVID policy, unless maybe the whole thing is declared over or whatever. But basically they move the goalposts because they have to get the economy going at some point. And it seems to me that point can't be too distant. So we've got Xi's coronation is done. I think it's a mistake to expect any instant changes, but I think we can probably start to see redefinitions for what constitutes a COVID outbreak, right? That sort of thing. We do have winter coming, though, to China, so they'll probably be a little bit tight. But I think at some point, and it probably not later than next spring, we do see China join the Great Reopening. Or maybe everybody else, it's, the Great Reopening is over. So join may not be the right word, but the Chinese version of the Great Reopening. And, we had a year of pent up demand, and that produced a surge in airlines and all kinds of other things when the West reopened. China is now going on 2.5. The pent up demand from China, I think, will be enormous. So there's a case to be made that, come early next year, that we're going to see a lot of what has held the global economy back come back with gusto as China gets back into it. And then there's what you're saying in the West. Of course, we have the war and the economic war, and things could get worse for Europe. But I do think that actually invites more fiscal response. So even if things like objectively are worse, and probably the right thing to do would be to embrace austerity and clean up our house and get things in order, I don't think the people who are pandering to voters have any interest in that at all. I think they're going to, no fault of their own has now been established as a reason to send people checks in the mail. And a recession is no fault of anybody's own, of course. So I really think that we're going to see fiscal response very quickly. So my sense of the human critter is again that it will be a mistake to assume that the commodities bull is over. I mean, okay, if it depends on how you define it. But if there's another one that starts in a quarter or two, is it really a new one? Look at a longer term chart. I think people will see the current time as a correction. Well, though technically, if you go under 20%, right, bear market, whatever, we can argue about definitions. But I think longer term, people will think of what we're going through right now as a retracement. Well, let me give you an analogy, and I'll hand it back to you. In the 70s, we had that huge reversal in gold in the middle of the 70s. As the Fed and other factors waffled back and forth, and as the economy went up and down and so on, there was a huge correction in the 70s. And yet we refer to the 70s as the great bull market in gold, not the great bull markets.
Well, there are actually some commodities, Lewis, that are doing really well right now. I mean, oil's holding up relatively well. Coal's on fire right now because Chinese are just importing enormous amounts of coal, and these politicians with their ESG policies, they banned coal mining in many different countries. You have the agriculture indexes, so like the Rogers Raw Materials Index, which tracks a lot of soft commodities, that's actually holding up really well. And then platinum group metals are actually doing pretty well too. So there are some commodities that are doing well. But I would
add lithium. Don't forget lithium. I mean, platinum is holding up well in that it's doing not so bad, but it's not like way up. It hasn't retaken its crown from gold, whereas lithium is still up there around all-time highs. And by the way, you talk about ESG and so on, lowly, much hated uranium is having a good year. It's been a very volatile 2 steps forward, 1 step back pattern for the last 5 years. But it is in a very strong looking upward trend, I think.
And high energy prices are actually causing an enormous amount of problems for the companies in the supply chain, the value chain, other commodities producers. I think a lot of these Chinese steel companies are insolvent now because of higher costs. You have aluminum companies, aluminum smelters in Europe. I think almost 70% of European fertilizer production is offline now because natural gas prices are so much higher. So there's opportunities there. So if you're an American fertilizer company with, on a relative basis, much cheaper natural gas prices, especially after these corrections, you're going to make a lot of money making fertilizer and then exporting that fertilizer because your input costs are way cheaper to other countries.
Yeah, I agree. Though the takeaway here, the what to do is not to run out immediately after listening to this interview and start buying all this stuff. I'm sorry to say it, but my view is actually to look for more pain. And particularly for the things that are up or having a great year, there's less opportunity. But for the things that are necessary and that are down, look for tax loss harvesting opportunities. I think we're going to have an interesting tax loss season. It might not be as terrific for buyers as you might think, because normally the worst tax loss seasons come when other sectors are doing great, right? The tech sector is flying high. People have made ridiculous amounts of money in other markets, and the resource sector is down. So all the miners get whacked in tax loss season. This year, most sectors are down. Even the energy sector as a whole, it has its bright spots, but overall it's still struggling. So I'm not sure there'll actually be that much pressure to harvest tax losses this year, at least for US investors. In other countries, it's different, and how your carry forwards and what you can use your tax losses to offset are different in different jurisdictions. So without getting lost in the weeds, it may not be quite as spectacular that I would be hoping for as a buyer, but I do think we're going to see tax loss selling in the resource space in the months ahead. And I do think that's something to look forward to. Look for something where you're quite convinced of the thesis, right? Copper is in demand anyway. It's Dr. Copper, and then all these EV cars on top of it. You're bullish for copper for decades to come, which I am. I'm not buying any copper stocks right now, but if they go on sale during tax loss season, stupid cheap, or if the Fed breaks something and everything, we had a real market crash and everything goes on sale, that could tempt me.
Now, in the other bear markets you've been through, normally the companies like Franco-Nevada, Royal Gold, Wheaton Precious Metals, it used to be Silver Wheaton, they've gone in and they have much cheaper cost of capital. They have good profit margins, good free cash flow, good diversification. They've gone in these bear markets and they just take advantage. Normally it's the base metal miners, where the base metal miners, the mines start running at losses. There's no access to capital. The base metal miner gets in trouble with their balance sheet. And so Franco-Nevada goes in and says, here's 80 million, or here's 100 million, 150, 200 million. We're going to buy a gold or silver byproduct stream. Do you expect more of that to happen if the...
Yes. So there's sort of good news and bad news with that too, in that obviously that's the right thing to do. It's the smart thing to do, but it means that the company is is putting out capital at a time where prices are down and investor sentiment is negative. So you can see the companies make just brilliant acquisitions that aren't possible when the markets are frothy. I mean, absolutely the right thing to do and get absolutely no reward for it at all. And so, if you're looking at this ahead of you, it's painful, and I'm sorry if I keep promising more pain here, but that's not my intention.
Well,
but
these things are cycles, so you're just
right,
saying that in the short term, probably more the probability then of pain, bear market is high.
Right. So, and all I'm saying is that it's important to keep hold of this, because when you see something like that, like Franco or any one of these, Royal or Wheaton is now grown up and it's at the grown ups table, and one of these big players, if they make something that's objectively extremely value accretive, and they get nothing for it in the marketplace, or the Fed breaks the market and they go, it becomes the baby thrown out with the bathwater, then you need to screw up your courage and take advantage of that, because the value proposition has gotten so much better. And normally, as a speculator, you've asked about what I do in past bear markets. Normally, as a speculator, I bet on the juniors because there's more alpha, right? They're more volatile, and so when things are good, the volatility upside is better. I don't expect the bigger players to be 5-baggers or 10-baggers. But if you can get them on sale on this stupid cheap discount rack, then that's actually possible. And the risk of something like betting on a Franco or a major miner. I remember, as an example, in 2008, talking copper here, it was Freeport. It was a $50 stock, $55, I think, and it went down to $3. It was down, right? It was down more than 90%. And I remember going to Doug and the people at Casey Research and look and okay, this isn't normally the kind of company we would speculate on. It's much too big for us, but it's on sale 90% off. Like, it's not going away. This is a stupid cheap price. And they're like, well, that's true. And it wasn't Doug himself. It was more the consensus. Like, that's true, but they have debt covenants and copper's down. And if we're going into a recession, right, this market crash might cause a recession, and copper might be a long time coming back. They could have all these problems. And we ended up not doing anything. And that stock went from $3 and change to over $60. So this was not a little junior that doesn't even have anything yet, or doesn't have money to drill its discovery, or any number of things could go wrong. This was Freeport bloody McMoran, and it was a
lowest cost copper miner, right? Yeah, the lowest cost one of the lowest cost copper miners on the planet.
Yeah, I'm not sure where they are now, but yeah, I mean, they're one of the top dogs in that space. It was, but listen to me, it was a 20-bagger. Like, that's the stuff we dream of getting with the juniors. So I guess this is the plus side to what I'm saying is, I hope I'm wrong, and maybe the powers that be will open the money floodgates sooner than I expected, and it'll be off to the races for everything soon. But if not, the upside is the downside, or the downside is the upside. The downside, the pain that we're likely to see, will create, I think, really spectacular buying opportunities. And if you can get the cat's meow, the best of the best on the deep discount rack, I will personally put money into stocks that I wouldn't normally bet on.
Yeah, I totally agree. Actually, when you brought up the Freeport McMoran copper example, I was actually looking because Lucas Lundin was running Lundin Mining, and they had all these excellent projects that were coming online. Then China announced that stimulus package to build all that infrastructure in 2009, 10, 11. I bought Lundin Mining at 30 cents a share, and everyone was telling me, oh, it's going to go bankrupt. It's going to go bankrupt. 18 months later, I didn't buy a lot of shares. I think I only bought like 500 shares. I sold them for $5 each. So I bought them at 30 cents. Awesome. And so, yeah. So I was just right out of college, and I was like scared because all the stuff I was reading, I was learning how to do contrarian research, and I was reading like Warren Buffett and Benjamin Graham books, and all the stuff I was reading was just negative. They're going bankrupt. Yes. They have a mine in Africa and it's going to get seized. And, everything was just as negative as it could be. And then China announced their stimulus package, the Fed announced QE, and boom, the copper price just took off.
My mentors, more experienced traders that I've spoken to, they tell me that the most lucrative trades they have ever made, after they hit that button and place the buy order, the natural response is to turn around to the waste paper basket and heave.
I actually had a conversation with Jim Rogers about that in emails. I was asking him in his experience with commodities, how long some of these miners can go running at losses. And he was like, maybe a couple quarters. He's like, depends how much capital is available, because basically they just burn. They go through the cash on their balance sheet, they burn. And if they can't draw down credit, from their revolving credit facility, I mean, now there's more capital with the available with a gold or silver byproduct stream. But if you're a high cost miner, you're not going to get that either.
Yeah, no, it's tough. And it sounds stupid. Like, why don't they just shut down? If they're not making money, why don't you just shut down, save the asset? Why deplete? All mines are self-destructive by definition. They deplete. The more you mine, the less you have left to mine. I mean, you can discover more, but whatever you have that's defined, your proven and probable reserves, right? Every ounce or pound that you take out of the ground is one less that you have to mine. So why don't they stop? Well, again, there's the cost that we talked about, but the other thing is, if you do and the market turns, then it takes a long time for it's like the bow of the Titanic, right? It takes a long time to get a big business like that going again, and the investors won't forgive you. So I remember, for example, again, 2008, 2009, there were companies that did that. They even on the exploration, they stopped drilling, they stopped exploring. They're like, we're going to conserve cash, we're going to wait for the market to come back. And the other ones that said, no, we think it's going to come back quick, it's going to be V-shape, and they just went full speed ahead right through the pain. Those guys in early 2009, they were like doubles, triples, quadruples, they were just screaming upwards. And the other ones, they were dragging along this long U-shaped recovery. And it wasn't really until late 2009, 2010 that these other ones started benefiting from the higher prices and the capital coming back to the sector. So, it's not entirely crazy or stupid for the miners to say, well, I believe in this. This is my outlook, and I'm going to place my chips accordingly. But if they get it wrong, phenomenal destruction of capital, and a lot of investors' money goes to money heaven. So it's definitely, like you mentioned, Graham and Dodd, and I think there was a place in securities analysis where they even mentioned that the whole business of mining is not suitable for Graham Dodd type analysis, because just the underlying commodities are just too volatile to make. It's not like a shoe factory where you can have more predictability in your output and demand and so on. So yeah, we call ourselves resource investors, but that's actually why I embrace Doug's speculator mantra. I think we're all speculators, even in the biggest mining companies, the Rio Tintos and BHPs of the world. Don't kid yourself. You're not investing, you're speculating.
Well, those large base metal miners, they're also so large at producing copper and iron ore and nickel and other things. A lot of them are unhedged. So they might only have a tiny fraction of their total metals production hedged. I've interviewed Rick Roll, and this is what he said.
Well, they also don't need the hedges as much as a little guy. Especially like if you're a one asset miner, right? You just have that one mine, and you can set a hedge that guarantees your profitability. You think, that's pretty attractive, because whatever happens,
banks will if you're a one asset, like small, medium sized junior producer with one pretty good mine, I mean, the banks are probably going to force you to hedge at least part of the production for 5 years just to get a loan.
Yes. No, that's no question. If you're a first time mine builder and you go to a conventional finance, a bank, a hedge is almost, I can't tell you it's 100%. I don't have that number, but it sure looks that way to me.
Oh, I agree. It's there's a specific language in the debt covenants about certain amounts. They won't even give you the loan if you don't agree to a certain amount of hedging for small and medium sized producers with one or two assets. Yeah, that's just unfortunately how it works. I want to get your thoughts now on the London Metals Exchange warehouses. So I've seen a lot of people show charts all over financial Twitter about there's basically no aluminum in the London Metals Exchange warehouse. I think there's a couple other metals. There was a short squeeze also in nickel. I think you said about February or March of this year in 2022. We're recording this interview on Tuesday, October 25th, 2022 for our listeners out there. So if there's so little metal in these warehouses and the miners are having problems, do you think then that means supply destruction is imminent?
Well, yes and no. The LME is not the only clearinghouse in the world, and its problems are, it is important. I'm not dismissing it, but it's not like there's no way to root around. And Also, some of it is, I won't say self-inflicted because it's the political times. Like if you say we're not accepting nickel or aluminum from Russia, uh, that's not the sort of thing that you can instantly replace. But if a lot of that was going to end up in China anyway, China has no problem getting that directly from Russia. So it's not like the world has only one way and it must go through the LME. And the other thing to remember is that, okay, LME stocks, we do chart those, and it is, other things being equal, if LME stocks are low, then that can be a catalyst for higher prices. But in the current world, with the new Iron Curtain going up, supply chains rerouting anyway, I would say this is a time where other things are not equal. And remember that, this isn't like gold that you mine it and most of it just sits there. You, as Warren Buffett complains, right? You dig it out of one hole in the ground, you spend a bunch of money refining it, and then you put it in another hole in the ground, put a guard over it, right? What's the point? Everything else gets consumed, even silver. People make a big fuss about how low the silver stocks are, but silver is consumed every day. Like most of the silver goes to people who use it to make stuff. So the stocks are constantly turning over, and they go up and they go down. But it doesn't represent anything about like the overall availability of the metal to the market, the amount that's in LME at that particular point in time. You understand what I'm saying? Like,
so you're saying that the people that they're calling a base metal rally and pointing to these charts, but that they're too premature and they're not understanding that China's just going to get the supply directly from Russia then?
Yes. I mean, that's a simplification, but yes, the premature part for sure. I would not look at just the LME, certainly as the only variable.
Well, didn't you also mention before we started recording that there's Chinese warehouses on the Yangtze River, the El River, that are actually running really low on copper right now?
Right. But see, this is, yes, they're almost out, actually, as far as I understand. This is like the biggest actual physical warehouse, deposit of copper in the world, ready to go out to be used in final fabrication. And as I understand, the latest reports is that it's almost empty. But this doesn't mean that they can't contract and do other things. And that was a bonded warehouse where these things were stacked and stored and borrowed against. But the end user can short that part of the supply chain out. So I would be cautious about reading too much into this. But on the bright side is, if I'm wrong, and it's premature to get too excited about these things, it is very bullish. So it's the sort of thing that we'll start seeing in the prices. So if we start seeing the prices of aluminum, nickel, copper, these other key industrial metals moving up in the face of recession, then that will be evidence at that point. Instead of just interpreting or thinking, oh, this means this will happen, I would rather wait till I see it actually happening. And if we see industrial metals prices rising in the face of recession, then we'll know that there really is supply not keeping up with even reduced demand. And that would give me much more confidence to move ahead and not wait for the recession to show its true colors.
Since you've done a lot of traveling and site visits, are there any high-grade, low-cost mines, projects, or countries maybe that you think our listeners should maybe add to their watch list now? Since now's not really the time to necessarily buy big positions in base metals, maybe over the next couple of quarters, they should start looking at these. These are projects long-term that after maybe a couple quarters or tax loss selling, that would be very interesting for you.
Boy, I'm going to be such a rain cloud on the parade here. I don't have low-hanging juicy fruit to recommend. I would actually turn the question around the other way and say that, never mind supply chains, like geopolitics and the zeitgeist, the ESG agenda is so anti-mining, and it has sunk in places that have previously been pro-mining. Excuse me. That you're seeing places that were previously really good jurisdictions become less good jurisdictions. A prime example would be Chile. And I know Chile has lots of fans and supporters out there, and I always get hate whenever I say something like this. But it is clearly going the wrong way there. And okay, they had some really scary measures in the proposed constitution that got voted down, and that was a sigh of relief for miners there. but they're already back with the forget the Constitution. Let's just go for higher taxes now. So it's not like the anti-mining people have given up. And my sense is really for over the last decade, Chile is a fairly wealthy country, and the people there, the average person there, they see the mining as part of the bad old times. And okay, we were a poorer country before, and we needed to have all this mining to build up our infrastructure and our industries, our other industries. But now we're a wealthier country, so we don't need no dirty mining. We have other industries.
But they're the Saudi Arabia of copper, though, right? So where's the copper supply going to come from if they're not mining it?
So that's sort of my point, is that actually, places that were great, are becoming much more sketchy. So watch out. Don't assume that places have been safe for mining. And another one, I hate to say it, is Mexico. Mexico has not become a no-fly zone for me, like Bolivia. And by the way, Chile is not a no-fly zone for me. I'm just saying it's headed the wrong direction. And things are pretty scary in Mexico now, too. In particular, regions are more dangerous than others. But it's not just, gangs and violence. It's rule of law. It's, really weird. Suddenly, some branch of the Mexican ministries, suing companies for royalties that were never part of the deal in the first place, or something. Things like that.
Are you talking about Fortuna Gold and Silver or First Majestic, or are there other companies?
There are others as well. So it's not just one, and there are some that are having no problem. There are some companies that are building mines or operating there with no problem at all, and there's others that clearly have. I don't know if it's some local official who's looking for a bribe and they won't pay the bribe, or what the problem is, but it's becoming more difficult. And clearly from the top, the administration, AMLO up there, he's no friend of the gringo miners. So that's a bit scary. If I could maybe go back to your question, though, and maybe try to put a positive note here, what Friedland has done in the DRC, the Democratic Republic of the Congo, a phenomenal endowment there. And I've made money on DRC companies before, but I've also been there, and I find it rather scary as well. But I have to say, the ministry has made scary noises. They talk about pulling back concessions and reconsidering their deals, sort of like Darth Vader in that second movie. Pray that I don't alter our agreement any further. Right. But they actually haven't done that. And Ivanhoe, and this isn't a recommendation, I'm just saying, as a canary in the coal mine, copper mine, they've been able to build the huge world-class high-grade copper project there and not get it nationalized, not get the government to suddenly say, oh, you know what, our 20% interest, now it's 40%. That sort of thing hasn't happened. And beyond the expansion phase too, like usually something like this, you get the nice Canadians to spend hundreds of millions or billions of dollars building a mine, and then after they build it, then you nationalize it. And that didn't happen in this case. So I'm not saying that that's the all clear and the DRC is now the best place in the world, but you ask for places that might have been overlooked where there's high grade stuff. The mineral endowment there is phenomenal, and there certainly could be more Ivanhoe type stories there in the DRC if you're willing to go there.
Yeah, I remember that Lundin Mining, actually, we were speaking about that in 2008, 2009. They actually owned with Freeport-McMoRan, I think 40-50% joint venture. They actually owned a large copper mine there in the DRC, and everyone's like, the government's going to seize the mine. Lundin Mining is going to go bankrupt. I was like, the Lundin family, I mean, normally they have a lot more wins than losses. They bought the assets for pennies, the gold mine for assets, pennies on the dollar from Kinross, and they turned that around in Ecuador. It's one of the best gold mines in the world for Lundin Gold now, Fruta del Norte.
Right. Well, that's funny that you mentioned that. That was my first trip to the DRC, was to go see Tenke Fungurume, the mine you're talking about. And at the time, it was a project. It hadn't been built yet. And it was one of these things where you go and you look at this high grade deposit, and this green mountain. And it's not green because of the jungle or the plants or the trees. It's green because it's exotic copper staining on the surface of this mountain. It's that rich. And then you stand there on this thing and you're looking at, not just this one high grade rock in your hand or something. Like the whole bloody mountain is green with oxidized copper, like the Statue of Liberty, right? And you stand there and you look at, there's another hill over there, and there's one beyond that in the haze, and they're all green for the same reason. And that's when you have this holy cow moment. Like, there is so much wealth here. And yes, they were able to build the mine and do well. I didn't get quite the phenomenal return on investment that you did, but but we bought before they built the mine, and I think Lundin Mining was a double or better for us back in my Casey days. And part of the due diligence wasn't just kicking the green rocks, but actually meeting with people there. At the time, the younger Kabila was up for election, and it was going to be the first election that might or might not result in a coup and so on. And getting a sense for how that election would go was part of my due diligence. I got that one right, and there was no coup. So that worked out to a really good investment for us. It's funny that you made money on that one too.
Yeah, I was looking at the grades and the costs, and obviously with the track record of the Lundin family, Lundin Mining. So they made a big bet there, and then their partner was Freeport McMoran. So you were researching that one as well. I think Lundin Gold has had a lot of success in Ecuador too. I mean, that mine.
It is a different company. I mean, it's same family, but it is
Yeah. Lundin Gold's a different company. Yeah, it's the same principles though. So they're going into an area where people say, "Don't invest. The government's going to seize the mine. Why would you invest there? You're crazy."
That's actually true. Now you mentioned that, and in writing in my Casey days, this was something that I would say. People would talk about different Ecuador plays, and I would say, well, let's see. Before it was Aurelian, and then it was Kinross, and then it was Lundin Gold, formerly Fortress Minerals. They had some Russia stuff I wasn't too keen on, but then they bought FDN in Ecuador, and people are excited. And I said, well, let's see if they can build the mine and not, get molested by the government in any way. They can build it and profit from it. Then, maybe I'll be less negative about Ecuador. And that's exactly what happened. And I have, Casey days, post Casey days, I have invested in Ecuador plays since then, because Ecuador has shown, as crazy as the place is, there was the low-hanging fruit, literally the fruta del norte, to steal, and they didn't. And that gave me quite a bit of confidence.
I think there's about a dozen different large mining companies that have made big investments. I know Franco-Nevada also bought like a $200 million gold stream on a potential new copper mine. So there's a lot of big mining companies now making investments into Ecuador.
Yeah, I mean, it is, but I never want to overstate this. I'm not a cheerleader. I'm trying to give the audience the most accurate information I can, not a, gilded lily, hooray for our side kind of presentation. That's all very positive, but, it was just 2 years ago that the government had to flee the capital. They had to leave Quito because of the protests.
Wow.
I mean, it didn't actually overturn the government, but I mean, it was, you think January 6th is scary in the US. The government actually had to leave the seat of power because people were so incensed over the COVID lockdowns and the gas price. I mean, they couldn't live. So it was very tumultuous.
Well, there's protests all over the world now due to inflation, high food and energy prices, or shortage. The emerging markets are getting screwed because a lot of that energy, the diesel, the natural gas, is going to Europe instead of emerging markets.
It's going to Europe, and if you're not producing it yourself and you're paying in dollars and you've got dollar debt, they're getting screwed, 5 ways from Sunday. And it's one thing to have labor regulations or other things that people care about. It's another thing if you go to the store and you can't afford food. This is the sort of thing that gets people out on the street. And I don't want to be too fear-mongery here or whatever, but I mean, honestly, the world is in a scary place. And whatever we invest in or speculate on, I think that's very separate from the issue of owning gold and silver bullion in my direct physical control. Like I can put my paws on my stack of silver eagles or my gold pandas or whatever. That's insurance. That's physical wealth. It's a long for which there is no short, that in the ultimate extremes of need is liquid. And you don't even need a computer to use it. So I just think that's different. When people talk about, gold bug speculations and so on, that's the stocks and the explorers and different things we can do. I don't think about buying bullion as a speculation or even as an investment. It's absolutely how I congeal wealth for long-term storage.
Couple more questions here before I let you go. So after this bear market in commodities is over, let's say there's total blood in the streets, or as Doug Casey says, the safe has hit the ground and there's cash all over the place and it's our job to start picking it up.
That was my metaphor.
Oh, that was yours? Oh, okay.
Back in Casey days.
Oh, I've heard other people credit Doug Casey with that. So you were the clever writer behind that one.
Well, let me put it this way. I remember coming up with that. Did I hear it first? But that's not a Dougism. There are a lot of Dougisms that I love to quote. Chances are slim to none, Slim's out of town, things like that. Other people's money was perhaps my favorite Doug Casey-ism. But I seem to recall having come up with that back in remember, I started writing for Doug in 2004. That's it's almost 20 years ago.
That's right around when the gold bull market first started, when gold was barely 300 or 400 an ounce, and people were like, oh, gold's dead. I think that was only a couple of years after gold. The mainstream financial media was publishing articles and magazine covers that gold is dead.
Right. And at the time, the central banks had to have an agreement between themselves not to sell too much gold, right? Because if they did, they would hurt each other. Remember that? The central bank gold agreement?
Yep. And the Bank of England, I think, and Canada sold almost all their gold, or nearly.
Canada was more recently, but yes, there was the famous, we call it the brown bottom. It was the Governor Brown sold the UK's gold. Like he almost literally bottom ticked the price of gold.
So which
but I've derailed your question. Sorry, what was your question?
Oh, which commodity? That was interesting, though. Which commodity specifically, supply demand fundamentals, do you think over the next 3, 4, or 5, maybe even longer term, have bright fundamental futures based on supply and demand? You said copper and lithium. Are those two of the main ones?
No. Copper, yes. Well, the thing about lithium is, when you have something at all-time high prices or near that, you have to wonder how sustainable that is. And clearly the lithium story is very strong. I do think, whether you think people should drive more electric cars or not, and personally, I'm a very free market oriented guy. I think the government should get out of this. They shouldn't be outlawing gas engines or creating tax incentives to get people to drive politically correct cars. But you know what? They don't ask me, and it's happening. So whether I think it should happen or not is really not a variable here. I'm looking at what is happening, and the ESG zeitgeist is there. I mean, just the reality is that entire generations are completely on board with this, and they vote, and it's happening whether we want it to or not. So more electric cars. Clearly, lithium is going to see very strong demand for many years to come. But it is not rare. There's a lot of it out there. And I just don't know. This is actually something we're researching right now, trying to get our minds around the various engineering companies and the reports. And they all have such different numbers. So I can't just quote some other guy and say, oh, we're going to have a lithium surplus or a lithium shortage. They have different numbers at them. So we're trying to come up with our own numbers on this.
That's interesting.
All I'm saying is as a caution is that, one of these two is at or near all-time highs and the other isn't, right? Copper is absolutely just as necessary as lithium for this whole story. But it has corrected substantially. It's back to almost pre-EV prices, if you will. The other one I should throw in there is nickel, because there's a lot of misinformation about the nickel market out there. And there's people with stock to pedal talking about how there's going to be this nickel shortage. When they say that, it's not actually untrue. What they're talking about is the class 1 nickel that's used in the batteries. But the other forms of nickel, there's a lot of, and by the way, not traded on the LME. Class 1 is traded on the LME, but there's this huge nickel market out there that never even goes near the LME. And the likes of Tesla is already going to directly contract in Indonesia with some of these people that supply not class 1 nickel. So I'm not bearish exactly on nickel, but I've written a free report. It's available at independentspeculator.com. If you'll forgive me for putting the plug in there, it's a free download. And you can look at our report on the nickel market. And the bottom line is not, oh, nickel's terrible. It's just resist the hype. There's a lot of hype out there about how it's going to go to the moon, and I'm not sure that's true. Of the three, I like for this EV story. Of the three, I like copper the best. Apart from short-term volatility, I think copper has the strongest story, and for decades to come. I'm also, it's not exactly an industrial metal, but it's an energy metal, which is part of industry related. I'm very, very bullish on uranium. It's one where I understand skepticism because people don't like it, and Fukushima and all this stuff. And there's been voluntary supply constraint. The biggest producers have voluntarily cut back their supply. But that was back when uranium was $18 a pound, and now it's around 50 and headed north. So it takes time for production to come back online. So I'm very, very bullish on uranium. And I think, the war in Eastern Europe, the potential banning of Russian uranium, all these things are extremely bullish for uranium. And by the way, uranium is used for baseload power. It's the sort of thing that you want to keep the lights on for hospitals and essential infrastructure. It's not just, something we use less of when we decide not to drive to grandma's because we're pinching pennies. So I see uranium as less vulnerable to an economic downturn than oil even, or other energy minerals. So the worst thing that can happen there is another nuclear accident, or perhaps a breach of the reactors in the war in Ukraine. Something like that would be bad. I'm not trying to say there's nothing that can go wrong here. But absent something exogenous like that, I think uranium, it just could barely be stronger. The fundamentals and the technicals, I think, are in strong agreement here. It's my highest conviction for the near-term trade. So copper, uranium are two of my favorite industrial minerals, which has been the focus of this conversation. But even though I said that gold and silver I buy for insurance purposes, as savings, and that's true, I do speculate on the stocks though. And I think there's the potential for both of those to take off at the drop of a hat. Just the wrong or right news, depending on your perspective, can bring the safe haven trade back for them. Silver, actually, I see as the win-win metal because it can benefit with gold from safe haven demand, but it's always been also an industrial metal, but its industrial side is becoming increasingly important. And guess what? It's also part of this electrification story. The solar panels, they all take silver, significant amounts of silver. And even if you have a new design that cuts back the amount of silver in there, if the proliferation of the solar panels is exponential, which it is, the better technology doesn't undo the silver story. So it has different ways of delivering for shareholders. So I'm very keen on silver.
And silver is right around $19.15 is the spot price. I mean, it's hated. If it goes another $1, $2 an ounce lower, I mean, a lot of these silver miners are in deep, deep trouble.
Yeah, they a couple of years ago we could say, hey, $19-20 an ounce, that's a great price. What are you complaining about? But the costs have risen. That's a whole other conversation we can have about the CapEx and OpEx blowouts that the industry is suffering. But just quickly, let me say there's another way of looking at this in terms of supply destruction. As we talked early on in our conversation, usually that supply destruction lags the demand destruction significantly. But when it happens, it's extremely destructive. And so the supply rebound lags the demand rebound even more. So if you can find the survivors, you can find the companies that can produce at lower costs. If you have, guys with all-in sustaining costs in the silver space for $15 or less, those guys, they'll be the few left standing if demand destruction really does start putting a lot of the other miners out of business. And just silver is an example. Same for copper or any of these other things. Look for the ones with strong survivability, and that can be a reasonable basis for a shopping list if we get a Fed-induced market crash or some extreme liquidity event like that.
Yeah, I also like the royalty companies because historically, and I've been through bear markets, not as many as you have, but I've been through the 2008 bear market and the 2015, 2016, the brutal one. And just watching when they do the deals, they're criticized, but 2, 3, 4, 5 years later, they just mint money. So that's normally how things play out in the space.
I agree. And I love the royalty plays too, but don't kid yourself about them being proof of anything. If you're even the larger ones, even the Francos and the Wheatons, they have some cornerstone assets. And if they are affected, again, this isn't a recommendation for or against Franco, but just for example, the Cobre Panama deal, when the Panamanian government started talking about potentially nationalizing that. And fortunately, they only stole $400 million, 375 or whatever it was. They only stole a few $100 million from the operator, which was fortunately, doesn't get passed on to Franco. That's the beauty of the royalty, right? But if it had gone the other way, if the government had nationalized it, that would have been a huge hit for Franco. And that can happen to any royalty play where, as we talked about earlier, the miners have an incentive to keep mining even at a loss for a long time. That's great for the royalties. as long as that lasts. But if they do have to shut down, then that's an instant and major impact. Especially the smaller the company or the smaller the royalty portfolio, the bigger the impact of any one adverse outcome like that.
Yeah, I mean, if they're doing a large deal in the short term, it becomes a concentrated percentage of the total revenues of the company. But over time, they will take that and they will diversify it further. But in the short term, there's risk then if they allocate a large portion of capital and then the deal goes bad. But we also saw that too with Royal Gold, where the shares, I think they had to restructure a large gold stream on a base metal mine because it became uneconomic because the gold stream was too large. I think the shares crashed almost 50% in about a month. This was years ago. This was the Mount Milligan gold stream.
Yes.
It was up and so they had to restructure gold stream. The market panicked. The shares crashed, I think, like over 50%. And it was a buying opportunity because within about 6 months, I think the shares were up enormously again.
Right. And, I've seen that in other ones. Wheaton also, I remember they had a deal with Alexco that basically it was the royalty that put that mine out of business. They just couldn't handle it. And so Alexco renegotiated the deal with Wheaton. And you might ask, well, why would Wheaton do that? We have a great royalty. Well, yeah, if you have a higher royalty on a mine that's shuttered, you're not getting anything. So there is an incentive to be reasonable and say, okay, well, they put a sliding scale in so that if silver prices went super high again, then they would get a higher payout. But if the silver prices were lower, then at least the miner could be back in business again and they could make some money. So, it is funny how these knee-jerk reactions are just so much. We talk about the so-called efficient market hypothesis, and there is something to that. There is such a thing as the wisdom of crowds, but people are emotional, and people in groups can be just as emotional. Right? And when you see people crushed to death in a stampede at a soccer match, then you can see just how wrong it is to assume that the wisdom of the masses is right. And that applies to markets. So I'm a big skeptic of the so-called efficient market hypothesis. As a resource speculator, my whole business is based on how irrational the markets are. The fact that things oversell, like the example you've just given, it creates buying opportunities. And the fact that people start chasing momentum and chase things to ridiculous highs gives us opportunities to lock in terrific profits. You have to be a contrarian. You have to have courage to do those waste bin hurling inducing trades when something is hated. But it's the very fact that markets are irrational and unfortunately can remain irrational longer than many investors can remain solvent. But it's that thing that creates the opportunity. It's why we're here. If they were perfectly rational and efficient, there'd be no room for the speculator.
Well said. Well, I want to thank you so much for our discussion today. If my listeners want to take a look at your work, follow you on Twitter, sign up for your paid newsletter, how do they do so?
Sure. I'm at Due Diligence Guy on Twitter. I'm on LinkedIn too. You can just look me up by name. The website is independentspeculator.com. There is a free weekly digest that has original research not published anywhere else. It's not even archived on our website at this point. So that's our incentive to sign up for the letter. And if you do, I promise we won't spam you with a flood of daily advertisements. I hate that stuff. So you sign up for the weekly email, you get one weekly email. And then whether you want to do further business with me is entirely up to you.
And you cover over 500 different stocks in your newsletter?
Well, there's two paid newsletters. The one called My Take is sort of like Consumer Reports. It has no portfolio. It doesn't have my stock picks or recommendations or anything. But it has a very clear summary analysis, the story, the pros, the cons, and then a thumbs up or thumbs down summary judgment of stocks requested by readers. So yes, there's over 500 companies in that database. We do update it monthly. So it's I've had to hire help.
It's too much team. Work for one person. Yeah.
I kept up with it until we got to about 400, and then it just got too much for me. So yeah, we have a team now. And the ultimate goal there is to be sort of like the Bloomberg of mining. And, I'm not always right, or I can't always predict which one's going to go up or down. But my pledge to my readers is that I work for them, right? No company can pay me any amount of money to get a thumbs up there. They have to earn it. I have to think they deserve that, or it doesn't get in there.
Well, also in this bear market, I mean, what's going up now for any commodity resource? Even if there's some good news, I mean, maybe it causes a temporary pop in the stock, but any bad news, so any company does a share dilution, any company announces a gold or silver byproduct streaming deal, I mean, that company is getting punished
Right.
in these
So
bear market
actually,
conditions.
it's interesting that you mentioned that, because there's a sort of flip side here. A lot of people, or early on in my take in this particular publication, people didn't get it. Like, where are the stock picks? Well, there aren't any. What? That's not what I want. But that's in a bull market where everybody's buying. In a bear market where people are selling or wondering, what do I hold on to? Is this worth holding? Well, then I'm sort of like the doctor that gives you the second opinion. Right? Well, here's my take on that company. And yeah, that's a pretty good one. I think that one has survivability. It can come through even, a Fed-induced market crash or something. Or no, that was really weak. They have no money in the bank, right? They're not going to be able to keep producing at these prices. They're already a loss, right? This is asking for pain. Get out while you can, right? So it's a little bit of a weird thing. I don't know anybody else that does anything quite like that. We also have, a flagship letter, the Independent Speculator, that does have a portfolio of my own hand-picked stocks that I put my own money into, by the way. I eat my own cooking, and that is the story. But my take is different. It's more like a consulting service without having to pay me $5,000 an hour, because we do it through a magazine, if that makes sense.
Excellent. Well, I really enjoyed your articles when you were writing Casey Research, so I'm sure your writing style is good if you're coming up with clever analogies about like a safe falling and all the cash falling on the ground and picking up, waiting to not get hit in the foot by the safe.
Yeah, I remember thinking about that. The question, but is not new. Like, this is a long time saying, like, don't try to catch a falling knife. There's also don't try to catch a falling safe. So that was the starting point. Of course, you don't try to catch a falling safe. But what happens when it hits the pavement? It crashes open, money bags pull out. There's an opportunity, right?
And there will be opportunities in this crisis. So it's probably not with a lot of these tech stocks that don't have any profits. And I think long term, there is a lot of demand for food, energy, base metals, other key commodities, and in the monetary metals like gold and silver. So long term, I think there's still a lot of demand for a lot of these key commodities.
All agreed.
Excellent. Well, thank you so much for your time. I really enjoyed our discussion today.
Thank you, Jason. Have a good one.